Hey, welcome everybody. Hope you're all doing super well today. And if you can believe it, we're almost to the end of halfway through the year. It's pretty crazy. It's June 28th, so a couple more days, and we're going to be at the end of June, which will put us 50% through probably the craziest year. I don't know. I've talked to a lot of people that have been around a while, and they said this is the craziest year they've ever seen with everything going on. So a couple more days we're there, and then next weekend is going to be 4th of July. So I hope you all are staying safe and getting ready for a wonderful holiday to celebrate our wonderful country. I had to put up a American flag behind me. We saw this at the store, and I was just like, I loved it. And so, I'm very proud to be an American. I'm excited for the 4th of July holiday. Our goal is to hopefully get over to the beaches, get some water, maybe get a little bit of barbecue, right? So that's all we're trying to do, just have a little bit of fun, enjoy the weekend, and then actually have some family coming down to visit from Northern California, which is going to be awesome. So we'll be spending more time at the beach during that week. But today I wanted to talk to you about some things, and what I call them is, kind of keys to financial integrity. And these are things that I consistently see people missing or just not being prepared for, or just not really understanding, that they need to have a plan for when it comes to making your transition to retirement successfully. So, I would say it's easy to get prepared for retirement in a sense, because you just got to put some money away, hopefully put away enough. And then, you got to get things in order and make sure you have enough money to survive, for hopefully a long retirement. But there's some things as you're getting prepared that you might not have ever had to deal with before you actually make the transition. So what I want to talk about is 7 things today, and I want to talk to you about some of the things I see people getting right, and some things I see people missing when it comes to getting these keys in place so that they can live with financial integrity. So we are going to jump right in, and as always, if you have questions about anything that I'm speaking about today, then go ahead and just drop them in the comment box. And before we wrap up, we'll do a Q&A session, and we will discuss those questions, and I'll do my best to answer them. Okay, I don't always have the answers, but I will do my best. All right, so let's pull this up here. All right, so financial integrity in retirement, 7 keys to a successful journey. And that's one thing that I want you to remember is retirement, it may feel like a moment in time, but in reality, it's a journey. For many folks that are retiring in their late 50s and early 60s, you could have 50 more percent, right, of the life you've lived so far to go, when it comes to this next 20 or 30 years, maybe even 40 years. And a lot of folks do kind of miss things that when it comes to planning for that long horizon that need to be thought about, that are really important to think about, prior to you actually making your retirement. So I want to bring this up today again. I get a lot of feedback from folks that just say, hey, you know what? I really like to get things in bite-sized pieces. Sometimes, like last week, we went deep, into just talking about bonds and bonds in your portfolio. And sometimes we're going to take things from more of a high level and discuss them from an area that ideally won't make you go to sleep, right? I know last week might have been a little bit intense for some people, but I know some people like that as well, because I know I got some nerds like myself that do tune in each week. So I appreciate you nerds, but this won't be quite as nerdy today, but I think it will be enlightening, and so hopefully you enjoy it. So before we jump in, I do have to let you know that everything here is for entertainment and educational purposes. No financial tax or investment advice is being provided here, okay? So let's talk about this. So I want to talk about financial integrity. And when I say financial integrity, I'm not saying like, oh, you're a bad person, if you're not doing these things or you don't have integrity. I just think it's terminology that describes that by doing things the right way, right? If we do things the right way and we live the right way, then generally things work out okay, right? So you can call this karma, for example, in your life, right? If you're living the right way in your life, if you are being a generous person, if you're a nice person, things seem to go a lot easier for most people that are like that. If you are a selfish person and you're a mean person, then you seem to have a lot more mean people in your life, right? This is kind of the law of the universe, right? So what we're going to talk about today is just having a plan for some of these things. And, for people, I don't know if I put this in here, but let's take a look. But for people age 55 to 64, only about 22% of them have a financial plan. And so this is really concerning. And again, it's why I do what I do today. And that's why our firm, Keep It Simple Financial Planning, is so focused on making sure everybody has a plan. Investments are great, and I think that's a huge part of making sure things go well, and to have an investment plan and some investment guidance. but you need to have an overall plan to make sure that these things we talk about today are in place. So let's just jump right in. Number one thing is making sure you have a plan so that you don't run out of money late in retirement. Obviously these are things that are hard to guarantee, right? We don't know if you're going to have a big health scare or something like that, or a big tragedy that goes on, like a meteor, goes through your roof and you don't happen to have that coverage, for example. But before you retire, you really should take the time to map out in detail your expenses, your expected expenses, healthcare, food, of course, basic housing, your vacations, maybe some giving, all the little things that are going to be coming up over time, and also including, the cost of inflation built into that. This is what I see so many people forget. I think right now with interest rates so low, there's a much higher peak in interest in things like annuities. If you know me, you know that I don't hate annuities, but I do see a lot of people try to use an annuity as their whole financial plan and their whole plan to provide income for their 30 or 40-year time period. And in all honesty, I think that's a mistake for most people to only rely on some like one product to do that, because the big thing is most of those do not have an inflation adjustment, right? So $4,000 today is only going to be worth about, $1,000 to $1,500 in 30 years. So these are things you got to think about down the road, because the cost of food is probably not going to be going down that much. The cost of gas is probably not going to be going down that much. And over time, things like travel and everything else seems to go up, right? For those of you that were around in the 70s or 80s, things were quite a bit less expensive there. Obviously, interest rates were higher for things like home purchase, but the cost of gas was under $1, right? So these things change over time, and I want to make sure that you have a plan that you can at least look year by year. You have a very specific game plan, so year by year, you have a plan so that you don't run out of money late in retirement, okay? Second thing here, maximizing your most active years. Okay, this is really important, okay, because what I find is that a lot of people who are trying to do their whole retirement plan on their own operate from a place of fear when it comes to spending a little bit extra in the early years, okay? And something that I've talked to my clients a lot about is, how I've seen people's health shift so quickly. It's been shift from, in a matter of like 1 to 3 months, people have gone from 100% healthy, can go anywhere in the world, walk up any mountain, do any hike that they want to do, to, wow, international travel may not be possible anymore because of health conditions. And obviously we know international travel right now is probably going to be limited, but we're talking here about 20 or 30 years. I really hope at some point, we clear this up, this Corona deal, so that we can get back to exploring the world, because that's such a nice thing to do, especially in retirement. But really maximizing your early years, is so important, because those are the years that you have the best chance to have the most health and the most active behavior and the most opportunity to do some of those things that might have been on that bucket list for the last 15, 20 years. And so maximizing these active years sometimes can be a little bit scary in a sense, because that might require you to spend a little bit more money in the early years than you probably would later on, right? Once things settle down. We typically look at retirement as, kind of 3 different time periods when it comes to mapping out your spending. The first time period, we call it the go-go years, right? So that's kind of your busy years. That's, for most people, it's between 5 to 10 years when they first retire and they want to go do all this stuff. They first break free from the job that's been restricting them all these years and not letting them more than 2 weeks of vacation. And there's all the things they want to do. Don't get me wrong. Some people get that out of their system early on, but the majority of people I speak to really want to maximize that first 5 to 10 years. So making sure you can spend the money in those years, because if we look at, things like what's called sequence of returns risk, okay? So sequence of returns risk is something that you might have heard of, but many people haven't. So I'll explain it briefly. But what it essentially boils down to is, if you have a large downturn early in retirement, okay, and let's say you have a lot of your money in equities, and so let's say your investment portfolio goes down like 30, 40%, for example, and you're drawing on those accounts while the market's down like that, you're essentially going to be selling off a lot more shares, right, of the funds or the stocks or whatever you may own. And so when that money comes back, it's not going to come back to anywhere near as high if the market came back to even what it was before, because you spent more shares, sold more shares off. So if that happens, and that sequence of returns, so early in retirement, you have a downturn in the market, and you're drawing, that can lead to a lot of stress on the back end of your retirement plan. So when it comes to maximizing these early years, I find that it's more prudent to be a little bit more conservative in the early years to make sure that you have that money there. Some people think they might be giving up on returns, but there is a balance between giving up on returns and then reducing that downside risk. I personally, when it comes to retirement, if I'm dealing with a 20 or 30-year-old, we're going to talk about letting the market go and, just stay in a high growth type of portfolio. But when you are having to provide your own income and you are having to sell off investments each quarter, each year, however you like to do your distributions, you really got to think about not selling too much in a down market. And with what we're dealing with right now, we have this global pandemic. It's just so unsure of what we're looking at here that we don't really have, a very clear forecast for these next few years. I mean, honestly, we don't all at any time, but never in history that I know of, or, you can enlighten me if you like, but never in history that I know of have we been dealing with this much stuff going on at one time when it comes to so many industries being impacted by this COVID-19 situation. So, they're talking about now in California, they're going to be closing down bars again, right, in Los Angeles. This probably wouldn't happen if we didn't have these big riots and protests and things like that where kind of got people together in one place that they shouldn't have been in. So, these are things that are just out of our control sometimes, because even if you stay home and you wear your mask and you wash your hands, you can't help if tens of thousands of people are out protesting for a cause that they are concerned about. So these are things that are now going to slow down the industry here, the restaurant industry, and they may continue to slow down the travel industry, right? So things like, airplanes, cruises, all that type of stuff. When you own stocks, or if you own, if you have those things that you want to do, that can be a real challenge to maximizing your early years. So again, all that to say, maximizing your most active years is very important. So you want to make sure that you map out your income need, and then just keep aside a little bit extra money on the safe side so that you have that money there that you need at least the next 2 or 3 years. Some people like to keep in 5 or even 10 years of very, very safe type of money, even if you earn a low interest, but at least it won't go down, okay? So I will leave that maximizing your most active years at that. Again, if you have any comments, by the way, go ahead and leave those in the comment section. I'll get to those. Okay, the second thing that I don't think most people think about too much, because I'm seeing more and more people, just put everything into a target date retirement fund and just kind of doing it all in one fund and making things easy. So, when we talk about here about managing investment growth and distributions, if you have everything in a target fund, they're not the worst thing in the world by far. You could do a lot worse than that. But the challenge is, they keep the allocation the same for everybody, right? And so at 65, generally you're going to see a huge drop off, and it might be as low as 20 or 30% equities in your portfolio, which you got to make sure that that's going to be enough for you to actually meet your goals. And so I'm actually a bigger fan that once you're getting ready to cross to retirement, prior to retirement, there's nothing wrong with a target date fund per se if you're doing things on your own. But prior to retirement, I think you do need to have a portfolio that is quite a bit more diversified and broken up into different funds so that you can keep track of what's going on in your individual areas of your portfolio, right? And you want to keep things like different terms of bonds, right? Maybe you want to keep some cash, so that's not doing anything. Maybe you want to keep some short-term bonds that are like 1 or 2 or 3 year type of duration so that that money is going to be very safe. And then you definitely want to have some bonds that are more of the longer term, because there's plenty of bond funds that are doing 5, 7, 8, 9, 10% over time. And so you don't want to totally put everything all in cash, but it's finding the balance there. And if you have everything in a target date fund, that can really limit your ability to manage your portfolio, and you're just kind of left with what it is. So managing your investment growth is going to be a couple things there, which is diversifying your portfolio properly. And then the other side is when you need to take money out, setting up those distributions so the money comes from the right place. And then, over time, obviously, generally at least once a year, maybe 2, 3, or 4 times a year, depending on your style, you want to actually rebalance your accounts back to your target allocation, and then review the funds that you are invested in, right? And you want to make sure that the funds you're invested in are still the right funds for you. These are some things to think about right now, especially because when we look at, global investing, which I still believe is a good thing, by the way, there are certain areas of the world that are going to struggle more than other areas when it comes to the current recovery. But when you look at areas like in, let's say, emerging markets, for example, if you look at just a general emerging markets index fund, last 5 or 10 years, I haven't done all that great. It's kind of just been a lot of up and down. But, you have to remember that over the next 5 years or so, there's expected to be somewhere between 2 to 3 billion more people coming online. And if you haven't heard, Facebook has now bought this company called Jio, J-I-O, I believe it is. And that is essentially an e-commerce company in India. Okay. And now Amazon has moved into India. India has over 8 billion people, and a ton of those people are not online, or they're just very, they're kind of barely online with the basic type of Android phone, not full internet capabilities. So, my point of me saying all this is that there's going to be a lot of new companies coming out of these areas once they get access to the internet, once they're able to start their own companies. So, by having a portfolio that is designed to kind of pick up on those opportunities, these are things when it comes to managing your investment growth and distributions are going to be part of the formula. So again, these are things that you really want to have a plan for to make sure that you're managing your investments and your distributions in a way that will not only help you meet your goals, but also make sure you have the money you need when you need it, right? Especially early on, okay? All right. This is a subject here, keeping your taxes as low as possible. This is a subject here that probably 9 out of 10 people I speak to, even if they have a financial advisor currently, their financial advisor is not talking about this. Most financial advisors are of the broker type, right? I think we talked about this before, kind of the two-hat advisor. They may say they're a fiduciary, but they sell insurance and annuities, on the side. And it's about 95% of advisors out there that are in this, commission world that are known as a broker. And again, I'm not saying they're bad people. I'm just saying that when you're in that world, they are not really allowed to talk to you about taxes, right? And they're not really able to help you with tax planning because there is actually higher risk there for bad advice, number one. But two, their companies just don't allow them to advise on that. So there's going to be, probably many of you out there that have said, hey, you're working with your advisor, you're having your annual meeting, and you bring up a question about, well, what about taxes? What do I do about taxes in retirement? And they say, well, talk to your CPA about that, right? And I think a CPA is a great tool to have and a great professional to work with. But what I find a lot of times is CPAs are really only focused on this year and last year, right? Very few CPAs I talk to want to do forward-looking tax planning when that comes to things like how do we keep your taxes low over the next 10 to 15 years? Because, and they have a point, we don't know what the tax rates are going to be per se, okay? But we can also plan for that. And like, for example, what I do personally with clients is I use the current tax numbers we have today, and I use those through 2025 because after 2025, the tax rates are set to reset back to what they were prior to the TCJA, the Tax Cut and Jobs Act, which was passed in 2016. So we assume that things are going to go back to, instead of 12%, it'll be 15, instead of 22, it'll be 24, and so forth, right? And if that's our worst case scenario. And so we're being conservative in that sense. So if things stay where they're at and we can continue this tax plan, then great. And then we also look at what happens if taxes go up in the future. How is that going to impact your retirement? So let's be honest, folks. It's more than likely, taxes are going to be going up in the future. We have about $6 trillion of money that has just been kind of put into the economy, which most likely, I don't know if we're ever going to try to pay this stuff back, but, someone's idea along the way is going to be to raise taxes, whether it's on you and the kind of the middle, kind of upper middle class, or some of the super wealthy folks that are making $100 million plus a year. We don't know that yet, but in general, you want to make sure you have a plan to keep taxes as low as possible, and you want to start with the blueprint, lay it out the best that you know today, and then every year you want to keep up on that and make sure that your tax planning is still the correct thing to do, what you're planning on doing each year, right? So this is part of maintaining your ongoing financial planning. So you'd be very, very surprised on the difference it can make if you have a good tax plan in place and you execute it early before you get to RMDs, which are also known as required minimum distributions, which start at 72 now and beyond if you are turning 70, 72 beyond 2020 or beyond. So you want to have a plan for this stuff, folks. And ideally, you want to have a plan before you decide to pull your Social Security, because once you pull your Social Security, if you start looking at, some more advanced techniques, things like partial Roth conversions, where you might move some money to a Roth account in the early years prior to 72. Well, if you're taking Social Security, the benefit of that conversion gets significantly reduced because you're going to be increasing your income and potentially causing you have to pay taxes on your Social Security. So ideally, if we can have a situation where we can do some tax planning before that, that is ideal. Not always possible, but hey, regardless, you want to have a plan to keep your taxes as low as possible, especially for you folks that have a bunch of money and the majority of your money in a pre-tax account. Okay, IRAs, 401ks, 403bs, TSPs, those type of accounts. If all your money's pre-tax, which is probably the right thing to do because you might be making more now than you'll make after retirement, but you want to have a plan on how do you get this money out, what account do you draw from, what order, that type of thing, to keep your taxes as low as possible. Okay. All right. So here's one thing that most folks just really, this is probably one of the biggest questions that we see, covering healthcare. Okay. So if you're going to be retiring 65 or after, it's pretty clear, right? So you're going to go on Medicare most likely, unless your spouse has a plan of some sort of work you're going to stay on. But prior to 65, covering healthcare right now is currently very tricky. Okay. So there's really, I guess you could say, about 3 ways to look at it. Number one is keeping COBRA. Okay, so COBRA is the essentially taking your healthcare from work and continuing that on. You'll pay the full amount of the healthcare. Generally, it's reasonably expensive for the most part, but you can keep that up to 18 months on average after you leave work to try to bridge you from retirement to Medicare. If you're retiring over 18 months ahead of time, then COBRA might be a short-term solution, maybe not. Second thing you can look at is some sort of private, right? There are private healthcare options, but those private healthcare options sometimes are limited and they may have pre-existing condition requirements that you may or may not be able to meet, okay? The third option is looking on like the ACA, so Affordable Care Act, or also known as Obamacare, or the exchange. This is where most people are going to look. This is where you probably heard of go to healthcare.gov and look at healthcare plans there. And those plans are going to be income based to see if you get a subsidy, right? So they have the metal plans, they call them, because they got bronze, silver, gold, all those type of things. So they're kind of like metals. But those are each going to have different coverage levels, right? So the bronze plan is going to have higher deductible. It's going to cover less, and the gold plan is going to have a lower deductible. It's going to cover more, but the bronze plan is going to be lower cost, and the gold plan is going to be higher cost, right? So, but if you can keep your MAGI, your modified adjusted gross income, which is your normal AGI plus any non or tax exempt interest, if you can keep that below the limits to qualify for a subsidy, this could be a great way to go for healthcare. But the thing is, the limit for a married couple is about $67,000. I think $67,400. 67,640, I believe it is. Don't quote me on that. I know it's around 67. So. But many people cannot live on $67,000, all growth, and that's just AGI, right? This is not after deductions. So if you're one of those folks that you have a pension, for example, that's going to bring in $60,000, $70,000 or more, you just have a higher draw because maybe you're still paying on your mortgage. This is where you really want to get into the planning on how you pay for healthcare early, because you can do things like maybe take a little bit extra out of your retirement account 1 year. So then that 1 year you'll pay higher healthcare, but then the next year, since you put money aside to cover healthcare, we can keep your income lower. And then that following year, you might be able to qualify for a subsidy, which can sometimes be $10,000 a year or even more. So that's called bunching, right? When it comes to your distributions. So these are things that you want to be thinking about. And then long-term care, okay? Most people I talk to just do not even want to think about long-term care. They're late 50s, early 60s, for example. And they're thinking like, what the heck do I want to do with long-term care? They're like, just give me a bottle of vodka, send me out in the snow and come find me in the morning, right? But in reality, folks, it's more than likely that if you were to face a long-term care type of situation, that you would not be walking out to the snow or heading to somewhere to just, end life early. That's probably not going to be the case. So what we recommend is that you have a plan to pay for it, okay? That can be an insurance-based plan where you can buy some long-term care insurance, which kind of the basic insurance somewhere, usually $200 to $500 a month. You can obviously go more. The hybrid policies can be as much as $10,000 or $20,000 a year, but that'll be a limited time for generally 5 to 10 years. Or you can look at self-funding. Many of the folks we talk to have a little bit more money than they need, and they would prefer to self-fund. And so really looking at the calculations on what makes the most sense for you. Does it look like self-funding could be an option? And if that looks like kind of a nervous option, then you may want to consider getting a policy to substitute. But again, you want to have a plan. You want to make sure you have a plan to cover these things in early retirement and also late retirement. Ideally, you don't want to have to sell your house to cover long-term care if need be, or do a reverse mortgage. Reverse mortgages are a tool, but passing on that house is from what I've seen, just a complete mess, a complete disaster when it comes to trying to pass that house on to your heirs. So if you have no heirs at all and you have no other money put aside, maybe something like a reverse mortgage could help you cover long-term care. But my preference is that you actually have a better plan than that, and you have things laid out in a way that you know you can pay for them, okay? So let's jump to our next one. Okay, this here comes to, your legacy planning. So making sure your legacy goals happen as you wish. Most people, don't have their estate planning in place. They might have a basic will, things like that. But with this new Secure Act, some big things have changed when it comes to you passing on your estate, especially if you have things like pre-tax IRAs or 401ks. Previously to the Secure Act, if you passed on your account to, let's say, a child, for one of your children, for example, which is kind of the normal, they would normally have the rest of their life, and they'd have a lifetime-based RMD based on their age. And if the person was on the younger side, they might have 30 or 40 years before they had to take the money out. Well, now the Secure Act has kind of turned that upside down. And so now if you pass on an IRA, for example, you have a 10-year time frame where all of that money has to be taken out. So, that could be not great, when it comes to keeping the hard-earned money that you saved and invested for all these years, because what might happen is, let's say the person you pass on this money to, let's say it's your son or daughter, and they're in their 50s, for example, and they're in their highest earning years at that point, right? Well, if they're in their highest earning years and you pass on, and let's just make up numbers here, but you pass on $1 million, IRA, which I know most of you want to spend it all, right? And leave them with just enough to cover your funeral and call it a day. But a lot more folks are going to be passing on inheritances over this next couple decades here. If you pass that on, and that money all has to be taken out within 10 years, and let's say someone is already in the 22 or even higher tax bracket because you did a good job as a parent, you raised very successful children, and that money has to come out and you have to pay full taxes on that, you could be giving away 30, 40, even 50% of that money to taxes, okay? So having a plan to make sure your legacy goals happen as you wish for your accounts is one thing, but you also want to make sure that you don't give money to people that don't really, you don't want them to have it essentially. Or maybe your money's not spent in a way that you don't really appreciate, right? So these are things that you want to have in your estate plan. So definitely having things like a will, possibly a living trust, your medical directives, make sure all your accounts are, the proper beneficiaries are assigned there, power of attorneys possibly on things. You really want to have all these things in place before you retire, or at least early in retirement, so that your legacy goals happen as you wish. Okay, very, very important stuff here. Okay, here's a big one. Okay, so here's a big one. So I hear from a lot of people that they say, why should I get a financial advisor? I could just do this on my own. Blah blah blah. It's it's easy stuff. One thing these folks I think are missing is how much work it is to keep up on ongoing regulations around retirement. Okay. Look at what's happened just this year alone, folks. We've had the Secure Act, which changed your RMD age, changed the distribution requirements, like I mentioned, if you pass on an account. They've opened up the ability to take $100,000 out of your 401k IRA early if you're experiencing financial hardship and paying that back over a few years and being taxed over a few years. They've removed the requirement to do an RMD this year, required distribution from your account if you are over 70 and a half or 72 in this year. They've even now allowed, as of this week, to totally break the rules. Normally, you only have 60 days to put a distribution from your IRA back into your account, and that's kind of what the legal standard is. But this week, they released that even if you took an RMD out in January, which was outside of the 60 days from when this coronavirus exception happened, you can still put it back in. And this is for all RMDs, right? So if you have an inherited IRA, you could possibly put the RMD back in. So these things are changing all the time. And so having somebody in your corner to help guide you and help keep you up on this stuff, you may think it's a cost. And I agree that sometimes it gets a little bit ridiculous on some advisor costs. I don't think some people should be charged as much as they do. But having somebody in your corner to help you keep up on these regulations could definitely be an investment, over time, especially when it comes to taxes and things like that, versus a cost, right? An investment versus a cost. So very, very important that you're doing this and you keep up on things. I do my best to keep you informed here, right, on things that we're talking about each week or things I share on the Pager group around regulations. But there's always things that seem to be popping up left and right. So you want to have a plan to make sure you're keeping up with ongoing regulations, okay? So that's what I have for you today. And I hope this was insightful and helpful for you. And what I want to say is if you don't have a plan for these items, then creating a plan to live with financial integrity should be at the top of your to-do list. Everybody should have a financial plan, okay? Maybe not everybody wants to have a financial advisor that they keep their whole life, but everybody should have a plan that helps them map out their retirement projections, their safe spending goals, their tax strategy, their investment strategy, their distribution strategy, their Social Security strategy, their pension strategy. These are all pieces of the puzzle that need to be put together. And you really have about one chance to get it right. I'm not saying you can't, everything's gonna happen all at once, but you got one chance to get this right. So you wanna make sure that you're getting this right. And, if you're not comfortable doing this with yourself, you should definitely work with a professional. I do recommend fee-only certified financial planners. And then obviously, I personally have a service where we do this, okay? I provide this for you, these workshops for you to provide value. You don't want to work with us, that's fine. But we are here and we can work with you pretty much anywhere you're at in the country, okay? So if you'd like to discuss working with us or just want to discuss your retirement strategy, I do provide what's called a complimentary retirement strategy call where I will personally spend about 45 minutes to an hour with you, mapping out your retirement game plan. And we'll talk about what's going well for you, what you're doing well, what are some opportunities there, and we'll help you create a kind of a step-by-step game plan on the things you need to do so that you can retire with confidence. If you want to do those things on your own, that's fine. But if you want to talk with me about getting our team to help you with that, then we can discuss that too, okay? So to do that, you'll go to my website at keepitsimplefinancial.com/talk. Once again, that's keepitsimplefinancial.com/talk, okay? So there is a question here. So if you have any questions, drop them please in the comments right now. I'm going to spend some time on Q&A and then we'll wrap up for today. So let's go here. All right, I see one question. Give me just a moment here while I pull this up. Okay, so Darla has a question here. What do you think at 62, retiring at 64, investing $100,000 in an annuity at 1.85% for 3 years? Okay, so this is a good question. So I would want to know, do you think 1.85 is going to change your life? Because you can invest in, I believe Capital One, just a savings account is paying like 1.25. Okay, so if you put your money into an annuity, you're losing liquidity. Okay, you're going to lose liquidity over these years, and if you need to take it out early, most likely you're going to have some sort of penalty. So if you can get 1.25 in a savings account, so the difference here we're talking about is 0.65%. So over 3 years it would be $650 a year, essentially on $100,000, so about $1,800. Okay, so it is something, but I actually think 1.85 is pretty low for an annuity. I'm seeing those paying about 2.29 at this point. So that, once you're getting over 2%, I think that might start to make a little bit of sense. But if I'm looking at a fully accessible account that can just be in a savings account, 100% safe, FDIC insured, no drama, no paperwork, that type of thing, versus an account where you get, about 0.5% more, but now my money's locked up for 3 years. When we have this coronavirus going on, when we have weird stuff happening every single week, we got protests, we got elections going on, all kinds of crazy stuff. So if you have enough money aside where this $100,000 is not going to be needed in any way, shape, or form, maybe you do that to try to get that extra money squeezed out of there. But to lock up that money for 3 years for about 0.5%, I don't know. For me personally, I probably wouldn't want to do that. Unless you had a lot of other money somewhere else that you just for sure wouldn't need this money. And I would actually be shopping around because like I said, I'm seeing annuities higher than this right now on that time period because I don't think 1.85 is very good. So I would recommend shopping that. Okay, so hopefully that was helpful for you. All right. This is a good one. Okay, James. James asks, I've heard that taking Social Security at 62 and investing the money works better than waiting to full retirement age. Okay. So number one, James, let's talk about a couple things here. Are you going to be fully retired at 62? Because if you're not and you're earning income, well, once you get above about $18,000, your payments for Social Security are going to get reduced, right? So the amount you get to take home are going to get reduced. You will get an adjustment once you get to, I believe, full retirement age, where you'll kind of make up that money over time, but you're not going to get the full check at that point. So if you're fully retired, okay, maybe you'll get the full check. Okay, so between, let's say, age 62 and then let's say full retirement age, you're going to get about 5.75% per year on that Social Security increase. That's guaranteed, okay? So let me ask you this. Can you find somewhere where you can guarantee that you're going to get better than a 5.75% return? If you do, I probably want to know, right? So that's probably a no. And so that's something you got to think about. If you put it in the market and the market goes well, then there's a chance that you can do that, right? But are you going to put into a 100% stock portfolio? Are you going to put into a 50-50 mix? Because 50-50 mix over time has netted you about 5 to 6% on average over long periods of time. So you're now putting your money in the market and adding risk to do this, right? To say you're going to do that. Okay. And then the final thing I'll mention on this question is, are you going to have the discipline to put 100% of that money into whatever investment you put it in for the whole time period so that you can guarantee that you're going to get this extra return that you're planning to do by putting it in the stock market? Do you think you can personally really put every penny of your Social Security for, let's say, 5 years from when you normally might delay from 62 to 67 for retirement age, not touch that money at all and have it there? I think that's a maybe, right? That discipline, I think, is going to be really tough to have. So I think there's a few things there you want to think about. And then the other thing I want you to think about is, longevity, okay? Because, over time, that money may do better in the market. What if it doesn't, though, right? What if we have a period like, and you put all your money in the S&P 500, for example, between January 2000 and December 2009, where you return negative 1%? Are you going to be happy, and is it worth the risk for you to do that? So there's a lot of things that come into play here, but it sounds like you don't need that money at 62. So this is where I get this decision becomes a much bigger decision. And I would recommend that you actually look at your whole retirement plan and you look how this particular variable and doing this or not doing this is going to come into play. And if you don't need the money at 62, you might be a great candidate for some tax planning that might be really beneficial for you on the long term that will pay off a whole lot more than trying to take this money early and investing it. And then remember that most people are going to break even on their Social Security about 76 to 78 years old. That's kind of normal. And if you're 65, your longevity is most likely around 84 for men and 86 for women, which means 50% of people are going to live longer than that. That's the average. And if you and your spouse are both 65, there's a 51% chance that one of you is going to live to 91 or beyond. Okay. So when it comes to Social Security, the big thing people don't think about is getting that increase each year. And if you started a smaller amount at 62, the amount that it is, let's say at 80, is quite a bit lower. I mean, I've seen easily $10, $20, or $30,000 a year less than you would be getting if you were to delay that. So I would recommend highly, James, that you look at the numbers on this, look at your situation, and use this as one piece of your puzzle to see what makes the most sense for you from an overall retirement planning perspective. Okay, hopefully that was helpful. All right, so this is a good one. Okay, Mark, if you're cash heavy in CDs and just starting retirement at 59, what does your crystal ball say on future rates? Is this still a fair strategy? Okay, so I don't have a crystal ball. I don't like to make a lot of guesses, but what I have listened to is the chairman of the Fed, Jay Clayton. Okay, oh no, not Jay Clayton. Jay Clayton is the head of the SEC. Anyways, I'll remember his name in a second. But anyways, the head of the Fed has said that they will be keeping interest rates at zero, possibly even lower, for as long as necessary. Okay, so what that means is we're probably looking at low interest rates for the foreseeable future. We don't even know how long this might be. So, once your CDs become mature, replicating, if you've had these for a while, and you might be getting 3 or 4% at this point if you've had these for a while, when these come out and you start earning, 1% or something like that, then you're starting to look at, okay, you're going to be making less than inflation. If your money's not even keeping up with inflation, you're essentially losing. The value of that money is going down each year. So these are things that are really, really important on the long term, but on the short term, not as important, right? So if you are looking at like 5 years, for example, the difference between making even 1% and 5% is really not that big a deal on the long term. And when it comes to like how much income that you can provide for yourself off of these investments, not a huge deal. But it's more so looking at that 10, 15, 20-year time frame that if you keep too much money, too conservative, then the value of that money may not keep up with inflation. And so the things you might need to buy in the future may not be worth anywhere near as much as they need to be. And Tim, thank you. It's Jerome Powell. Thank you. Tim mentioned Jerome Powell is the head of the Federal Reserve, and I actually met with him. Very, very nice guy. I had a meeting with him. I feel very confident with him there. This guy has a very good comprehensive of what's going on in the real world. So, yeah, so Jerome Powell did say that they will be keeping interest rates low as long as possible. They're going to use all their tools to help the economy recover. And this is why we're seeing huge unemployment, chaos in our country, but the market hasn't really reflected that because essentially we're propping it up, and we have been propping it up at this point. So the thing on the other side of that is we want to be really careful is that like if we're getting, this market's being propped up by just cash just flooding into the economy, that's a little bit on the dangerous side when it comes to, what your portfolio could do if we did have a downturn in the market. So, finding that balance between, cash and CDs and long-term investments is crucial for every investor. And I think it's an art and a science, right? So you want to make sure you can meet your goals, but also not go beyond your risk tolerance so that you don't make a bad decision at the wrong time. All right, hopefully that was helpful. All right, so there's one more question here I'm seeing, but I'm not quite sure. I'll do my best to answer this, but I'm not quite sure on the question. So do you pay tax on borrowers' money from life insurance and buy an annuity? Okay, so what I think you're saying is you have a cash value, some sort of cash value life insurance policy, and you're going to borrow money from that life insurance policy and quote unquote pay yourself back the interest, right? Or pay the interest on that, and then buy an annuity with that money. That's what I think you're saying. So, yeah, I just think I wouldn't really recommend that, first of all. But this sounds like one of those infinite baking type of things that people try to do, and I'm not a big proponent of that philosophy. But let's say you did take money, you put into an annuity that was not inside of an IRA. When you go to take the money out of the annuity, you're going to have, if you have a gain in annuity, which is most likely you will, which is why you're putting the money there, you're going to pay, you're going to get a portion of your money returned to you tax-free because that's your basis that was in there. And then a portion of that money is going to be taxed. So generally, annuities will have like a last in, first out type of situation where you might pay more tax up front, but then later down the road, you won't pay any tax at all. So you're going to have to really look at your particular products that you have and make a decision there. But I think that's what you're asking. And so I hope I answered that properly for you there, Martin. Awesome. So that's all the questions I'm seeing today, folks. I want to say thank you so much. I appreciate you watching. I would love to speak with you. Okay. If you are looking to plan for retirement, you want to get some guidance, it's a complimentary call. Go to keepitsimplefinancial.com/talk. Go back and watch this video. Take notes on the things that I mentioned today, and make sure you either do your research and create a plan for each of the things I mentioned today, or you get some help doing it if you want to save the time, the headache, and work with someone who's done over a couple hundred financial plans at this point. We'd love to discuss that with you, okay? So have a great day. Have a wonderful 4th of July, and we'll see you guys next time. Bye-bye now.